How climate change could impact the global financial market. Climate change, long deemed distant and abstract, has now come to one of the most pressing challenges that humans are likely to face. As temperatures in the world increase, natural disasters become more common and ecosystems shift irreversibly. So too have the effects of climate change started to resonate through every department of the global economy, particularly financial markets. It is no surprise that neither are the financial markets upon which flows of capital and investment around the world depend. Asset valuation and investor behavior, for instance, will likely be impacted in some way by ratcheting climate-related risks, as will global trade and insurance systems. This analysis reviews all the different ways climate change is set to reshape financial markets, both the risks and the opportunities for businesses, governments, and investors alike. Physical risks of climate change are the most direct and visible impacts. The risks from an umbrella standpoint include acute and chronic risk types. Acute physical risks involve sudden extreme events such as hurricanes, wildfires, floods, and heat waves. Catastrophic unexpected events batter communities, economies, and businesses, causing high levels of infrastructure damage, business interruption, and loss of property value. Such events directly and immediately affect the financial markets, including swelling insurance claims as well as the sudden devaluation of affected assets. For example, where a major coastal city floods due to rising sea levels or a powerful storm, the real estate market in that area will sharply decline because properties become uninsurable or too expensive to repair. This risk of financial loss is a growing threat to investors who hold assets in such regions. On the other hand, chronic physical risks are characterized by long-term changes that happen over decades. These include rising sea levels, changing weather patterns, persistent droughts, and changing agricultural conditions. Such issues pose high problems to businesses and industries. The agriculture sector remains one of the most affected in that crops face increased risks due to extreme climatic conditions. A serious drought in critical agricultural region may lead to markedly lower crop yields, thereby making the prices of food skyrocket while creating shortages in the production chain. Again, the energy sector is not an exception. It is also affected by weather-related shifts, such as when hydropower generators will experience low water levels when it is dry, thus creating electricity shortages to areas served by that source of energy. Physical risks are also there in the form of supply chain disruptions, and their effects trickle down to the global market levels. The supply chain-dependent major industries worldwide like electronics, automobiles, and manufacturing sectors will be sensitive to the disruption caused by climate change. A heat wave in one part of the world or a devastating flood in another can bring production to a grinding halt in key regions, leading to delayed delivery of goods and raw materials. For instance, the destruction of a key semiconductor manufacturing facility by a natural disaster will result in production lags for those dependent industries, leading to stock market fluctuations as investors respond to the character of this impact. These disruptions force firms to think anew about their operations and to diversify their supply chains, as well as to take steps that they hadn't had to take before to prepare for contingencies in those supply chains. Transition risks also plague the financial market, less immediate, but no less impactful. As nations, companies, and people start their journey toward decarbonization, entire financial systems will have to adapt to a new economic reality. Regulatory changes, shifting consumer preferences, and increasing sustainable finance are forcing the world toward a low-carbon economy. Subsequently, countries have passed more stringent environmental policies such as carbon pricing, emissions caps, and renewable energy mandates to try to attain global climate goals. Such policy changes may target a reduction in the global carbon footprint, but go on to expose industries and businesses heavily reliant on fossil fuels or other harmful practices to substantial risks. Changes in rules affecting industries related to coal, oil, and natural gas are very difficult to implement. For instance, the regulatory challenges of tightening emissions standards, carbon taxes, and even the threat of being locked out of some of the most important markets due to poor performance on the environment threaten them. Companies operating within high-carbon industries already have scrutiny from investors and regulators to find ways of making their operations better align with climate goals. Large institutional investors are starting to focus on sustainability issues, and the firms that are not working on reducing their carbon footprint or investing in greener technology will face growing challenges in accessing capital. However, there has been a rise in companies and investors geared towards taking advantage of the green funds investment and low-carbon technologies. Increased focus on sustainability investments is transforming global capital flows. Investors are increasingly scrutinizing companies based on their ESG performance and pushing capital toward firms that align with their values of sustainability. Specifically, a new window has opened to finance climate-friendly initiatives through the need for green bonds that fund environmentally friendly projects. Thus, for instance, pension funds, sovereign wealth funds, and insurance companies significantly invest their capital based on ESG factors. Those sectors most directly responsible for the climate crisis, such as fossil fuels, will experience downward pressure on their stock prices as capital is redeployed to more sustainable sectors. Both opportunities and disruptions will emerge in the form of technological innovations driven by the transition to a low-carbon economy. Such companies that operate at the cutting edge of green technologies such as solar and wind, electric vehicles, and energy storage will not only face more demand from customers but also have friendly policies from the government. The growth of the clean tech industry makes it a vast field for further investments because firms involved here would enjoy phenomenal growth. Beyond these and other forms of investment, innovations in carbon capture technologies or in energy efficiency will likely draw significant amounts of both private and public sector capital. For investors, this presents an opportunity to diversify their portfolios and gain exposure to emerging sectors that are poised to grow over the longer term. But with disruption comes also challenges. Industries that fail to adopt sustainable practices or to shift to cleaner technologies face growing risks of stranded assets. Stranded assets refer to investments that lose value since they become technically or financially obsolete due to changes in market conditions or regulatory environments. For example, if governments introduce more stringent emissions regulations and the fossil fuel reserve stock would be worthless for companies as it could leave large volumes of coal, oil, and gas reserves that cannot be exploited further. This would lead to steep asset devaluations in particularly the energy sector as investors back away from the high carbon intensity industries into sustainable alternatives. As such climate risks play out, there will be increased market volatility. The unpredictability of climate change coupled with this changing regulatory landscape raises uncertainty in the market further. In some instances, the swings might be sharp due to the novelty of information or a newly released policy. An example would be an emergency government regulation pertaining to carbon emissions. Valuations for stocks in such high-emitting industries might slip into unfathomable depths, while companies that spearhead sustainability would see their valuations shooting up to the sky. This also requires investors to become increasingly savvy at assessing climate risk, both in terms of the actual physical direct exposure of their assets and through the financial impacts of regulatory changes. More new tools and frameworks on climate risk disclosures are necessary for the investor to better understand what corporations are facing from climate-related threats. Climate change also raises credit and liquidity risks for financial institutions. Banks and other financiers lending to industries at risk of disruptions during climate-related events may well end up taking handsome losses if climate stress pushes borrowers into default positions. For example, agricultural lenders are likely to suffer more defaults arising from destroyed crops by drought or floods. Insurers are also becoming exposed to these uncertain natural catastrophes, causing them to potentially bear greater surcharges or limit coverage. Financial institutions, therefore, are likely to have to rebalance their portfolios and risk management approaches in the wake of these new and emerging threats. Although highly risky, there exist immense opportunities for growth in green finance and climate-resilient investments. As governments, businesses, and individuals all seek to reduce the adverse impacts of climate change, demand for sustainable projects and investments will continue to rise. Building climate-resilient infrastructure, from buildings and transportation systems to energy grids designed to withstand extreme weather events, represents an emerging sector that will likely attract significant investment. Such space is available in the area of sustainable urban development as well as green energy projects, which offer good scopes for investment, providing attractive long-term returns to those positioned well to capitalize on these trends. Conclusion: the financial consequences of climate change are immense and multifaceted. From extreme weather events and chronic climate shifts arises high physical risk, while the transition towards a low-carbon economy and the emergence of sustainable finance poses risks and opportunities for investors, businesses, and governments alike. Financial markets are at the forefront of this transformation as investors increasingly demand disclosures on climate risk, adopt sustainable investment strategies, and assess their portfolios for long-term sustainability. Stakeholders need to shift their risk management frameworks to the next sophistication level, invest in new emerging green technologies, and realign their strategies to a world where climate change is no longer a remote threat, but a definite reality shaping the future of global finance. Thanks for watching. Don't forget to like and subscribe to our YouTube channel.